New York's state pension fund, the third largest in the U.S., is cutting some of its investments in energy companies. The New York fund will divest corporate bonds and actively manage public equity holdings in 8 integrated oil and gas companies that State Comptroller Tom DiNapoli thinks aren't ready for the transition to a low-carbon economy. This includes selling a small portion of New York's Exxon Mobil stake. In a release this month, DiNapoli saying, quote, "Climate change is an increasingly urgent risk facing all investors, and I'm determined to protect the state's pension fund by keeping it at the forefront of efforts to mitigate risks to our investments." New York Comptroller Tom DiNapoli joins us right now. Good morning to you, Tom. We appreciate you joining us. I'm so curious about how you came to this conclusion and whether, frankly, you have any anxiety that when it comes to returns for your pensioners, that you won't be collecting as much as you could otherwise.
Well, you know, we're always looking at the long term. And we made a decision a number of years ago that climate change is a material risk to our fund, to our investments, and ultimately to our members. So we developed a climate action plan. And we've been going through a process with various sectors of the energy economy, first of all, to really assess whether or not companies are what we call transition ready. Do they have business plans that comport with the goals of the Paris Agreement, the emerging low carbon economy? Because we feel for the long term, and the pension fund is a long-term investor, those are better bets for us. So we just completed the process of looking at our integrated oil and gas holdings. And transition readiness, we measure with minimum standards. I want to emphasize the word minimum, but some of the companies, and you mentioned Exxon, fell short in terms of our assessment. And we did do a restriction in terms of the overall portfolio. It's a relatively small amount, but I think it sends a strong message, hopefully, to Exxon. They need to up their game.
So, but how much of this is about sending a message, if you will, as it is about trying to capture the best return on a long-term basis? And how do you decide on the timing of these things? Meaning, frankly, you could have argued 2 or 3 years ago the prevailing view about how quickly EVs were coming, for example, was that they were going to come much faster than they ultimately have. I could see the view today, unless you're arguing you're contrarian to the prevailing view, which might, by the way, be a good argument, that, frankly, EVs in that transition are a lot slower, and therefore maybe the value of these kinds of companies, which actually have been on quite a run, are more worthwhile, and maybe you should take this position 3 or 4 or 5 years from now.
Well, you know, investing is always a question of judgment, right? So, you know, we still have significant holdings in Exxon. We are limiting our active management and our corporate bonds, as you point out. It is part of a process, though. We have a very deliberate process to make an evaluation. And it's not just a question of limiting or restricting some of the investments. We're also looking to increase our investments, take advantage of the opportunities that we think are there. So we're doubling our commitment to our climate solution investment program. And we are continuing to be very involved on the engagement front. You know, this whole discussion came out of the very serious movement a couple of years ago to really talk about divestment across the board. Mm-hmm. And in New York, at the state level, we took a slightly different position. We said, you know, you can't deal with the climate change issue by just divesting your way out of it. Much of it has to do with policy at the government level, but investors certainly have a role to play, again, from the perspective of de-risking. The major oil companies that we continue to be invested in, we've made a judgment at a minimum level that they seem to get it. Whether it's Chevron or BP or Shell, they're making some efforts to be part of the transition. Exxon fell short in that regard. But because of our concern about returns, because much of our public equities are through passive investing, we are not in any way undermining the strategy
Tom,
of our index fund.
So maybe it's a moral question. Maybe it's an investing question. Many years ago, you may remember that CalPERS divested of its stakes in gun manufacturers. I've written a lot about gun manufacturers and gun issues in this country and the role that Wall Street and finance plays in them for a very long time. I think my feelings about guns are very well known. However, the truth is that divesting of those gun manufacturers ultimately lost the pensioners of CalPERS something on the order of $1 billion or $2 billion that they otherwise would have made. Do you think that that is a fair and good trade-off in the scheme of your responsibilities as a fiduciary, but also somebody who's in an elected role?
I do. Because, look, again, long-term, pension funds are going to be around forever. We're not just looking at short-term results. I think guns is a risky investment, given regulatory environment, laws, and obviously after the school shootings where we have school employees who are part of our pension fund, we have to be concerned about the gun issue. New York divested from guns as well. But when we do a divestment, whether it's the energy stocks we're talking about today or guns, before we make the final decision, we do an economic analysis. And that's why, Andrew, when we made the judgment to do the restriction on the actively managed Exxon part of the portfolio, we made a judgment that it would not be consistent with our fiduciary duty to take Exxon out of the index. So we do make an economic judgment to be in the best interest of our members. And before we make any decision about any restriction, we make that economic analysis. We get a fiduciary council opinion. We did that when we divested our gun holdings. They were very small holdings in New York. I don't know what the numbers were for California. And even when you're talking about the Exxon holdings, now you're talking about 26 million out of a portfolio of $260 billion. That is not violating our fiduciary responsibility. But we do want to see Exxon up its game, be part of the transition. That will make them a better company for us in the long term to be invested in.
So I'm just trying to understand. I remember Larry Fink got a lot of grief for some comments in Davos, I think, that we are forcing people's behavior to change. And I'm wondering whether that's what a fiduciary of a pension plan, whether you feel that you should bring that into your purview of what it is that you're doing for a living. You think that your long-term returns could be, for your pensioners, could be negatively affected by climate change's effect on ExxonMobil because they haven't transitioned? Is that what you're saying? Or are you trying to force behavior to grease the skids for the transition to clean energy? Which is it you're trying to do? Are you trying to maximize return to pensioners?
Yes. Yes, the latter point. We're not trying to force a change in behavior. We are taking the position that climate change is a risk. It's a risk to the planet, but it's also a risk to investors. And companies that are smart and are incorporating that risk into their business plans are going to be better positioned for the reality of where this world is moving to. Climate change is real, and it costs a lot of money across the board. And we all need to be engaged in dealing with that issue, including investors. Because if you're invested in companies that aren't assessing that risk and responding to it and anticipating the changes that are coming down and the economy that is developing, even it may be developing slower than some of us may perhaps would like or thought it would be. That's a risk. That's a risk to our long-term investments. Again, we're not day traders. We're looking long-term.
By 2050, there are estimates that demand for fossil fuels is not going to decrease by 2050. In fact, it's going to rise it's a big number, exactly how much you're going to need. You don't think the risks of Exxon cutting back on fossil fuel exploration and production, the risks is greater to your pensioners that they're not involved satisfying global demand for hydrocarbons for the next 25 years than they are? I don't even understand how you think the risk of there's going to be a lot of storms if we don't transition enough, and all the coal plants in China, the 300 that they're building, and in India, that somehow Exxon's actions by not transitioning fast enough are going to hurt your pensioners. The whole lot. The only thing I see is that you are morally forcing behavior. It has nothing to do with trying to maximize returns, because you're doing the wrong thing. In my view.
We're doing the right thing, which is why we're one of the best funded public pension plans in this country. Look, the Paris Agreement is real. The world economy is in a state of transition due to the climate crisis. We want to be part of a successful transition. Right. ExxonMobil and other major oil and gas companies need to be part of diversifying their business model. And look, it's going to go in fits and starts, and some of this gets very caught up in U.S. politics these days. But there is a movement that's underway. Climate change is real. It's a material risk to investors as well. And I think we've struck the right balance. Often we get pressure. People say, you should sell all of your oil and gas stocks. Well, we don't take that position. We want to be part of the transition.